Hello guys, today we're going to talk about a very popular indicator, the average true range. The average true range is a volatility indicator. Volatility in plain terms means the rate that the exchange rate is moving up or down. If the exchange rate is moving rapidly, then we have high volatility. If it's moving slowly, we have low volatility. I will talk about how the average true range is calculated and how to use it in your trading. The average true range is an indicator that was developed by Wells Wilder, and if you want, you can check out episode 14 when we talk about some other famous indicators developed by him, the Bollinger Bands, the RSI, and the parabolic SAR. The indicator is calculated upon the concept of true range. True range is the higher values out of the three following ranges: current high minus current low, current high minus previous close, and current low minus previous close. We're going to go to cTrader where I'm going to show you how the average true range looks like and how it's usually used in trading. Let's plot the average true range indicator. It's located in volatility. It's the first indicator here. The default periods for the average true range is 14 periods. The amount of periods determine how many of the true ranges will be taken into account for each point of the indicator. The indicator shows market volatility, that means that its value is rising where volatility is rising. As we can see here on the chart, the volatility is sharply rising. Remember, the volatility doesn't have a direction, it's not long or short. The volatility means that there is sharp movement. So every time you see in this chart that there is sharp movement, the indicator is rising. The value of the indicator expresses the volatility range of the period that we have set it for. I will try to explain the indicator better with an example. So let's try to set the indicator to 1 period. The indicator will show us the range of each of these candlesticks because we've set it to 1 period, so there is no average anymore. If we zoom in to this big candlestick here, we're going to see that the indicator's price is 0.0060, and that is 60 pips. And if we measure the candlestick, we're going to see that it's exactly 60 pips. Setting the indicator to the default 14 periods will show the range of the exchange rate for the last 14 periods. In this case, we have a 1 hour chart, so it's going to be the last 14 hours. Let's assume that we are trading hourly charts like we have here and keep our positions for 1 day. So it makes more sense to set the periods to 24 periods because now it gives us an average true range of every 24 hours for the last day. Now that I have explained how the indicator works, let's talk about how you can use the indicator in your trading. The indicator is usually used in order to find out how many pips away you're going to put your stop loss. The reason why you can do that with the average true range is because you understand the volatility of the market, so you understand how much the market is supposed to be moving, and you can set your stop loss outside that range. Let's go back to cTrader where I'm going to show you exactly what I mean. We see on the chart that the average true range for the currency pair now is 15 pips. So let's imagine that we're going to enter long here because we see an uptrend going. It's not a very good place to go, but anyway, just for the example. We know that the average true range of the last 24 periods is 15 pips, as we see here on the indicator. So if we put our stop loss into, for example, 5 pips, we know that the next 24 hours there is a very high probability that our stop loss is going to be hit. If we put our stop loss to exactly 15 pips, we know that we are at the edge of the range and there is a probability that it's going to be hit. Maybe it's going to be hit, maybe not. If we put it or even more on like 20 or 25 pips, then there is a low probability that it's going to be hit on the next 24 hours, based, of course, on the previous data. There is no correct placement of the stop loss. It depends on your trading system, your risk to reward ratio, and how much time you expect to hold your position. For more information in placing stop losses, please check out episode 4, Forex Risk Management. For this specific example, I see that the average true range, as we said before, is 15 pips. In my system, I'm using 2 to 1 risk to reward ratio. So based on that information, I will place my stop loss at 1 or 1.5 times of the average true range, which is around 20 pips. 23 actually. I'm going to place my take profit on 2 to 1 risk reward ratio at 40 6 pips. There is no correct ratio or multiplier to use for the average true range. It all depends on your trading system and what you want to do. Other traders use 2 times the multiply average true range by 2 times or 3 times. Other traders will divide it by half. Anyway, now that we covered how we're using the ATR stop loss, let's talk about another famous way of using ATR, average true range, is a trailing stop. A trailing stop is a stop loss order that follows the spot price from a specific distance and only moves with the direction of your order. In this chart here that we see we have a trend, let's assume that this is our trailing stop. What the trailing stop will do is it's going to follow the price on a specific range. Let's say that the range is 11 pips like here. So it's going to be following the price 11 pips. The price is going to be going up and the trailing stop is going to be going up with the price. However, the trailing stop is not going to be going down when the price goes down because it moves only with the direction of the trend or the direction of your order. So at some point here, it's going to move 11 pips away from the price. So let's say that it's at this point. And you see the price is going to go up and then the price is going to go down and it's going to hit your stop loss. However, in this case, your stop loss acts more like a take profit because you're going to get from here to here, you're going to get this amount of pips. And if we enter again here, the trailing stop is going to continue going up and it's going to be hit again here. So you understand what a trailing stop is. cTrader features a pretty solid advanced trailing stop. So let me show you how to use a cTrader's trailing stop. If we make a position, we created an order, it's filled, it's got to a position. If we click here this sealed icon, you're going to go to advanced stop loss here. We have a trading stop loss. You have 2 parameters here, trigger when gaining. You specify here how many pips your position must be winning for the trailing stop to start trailing. And trail 4, you specify here how many pips below the spot price or above the spot price the stop loss will remain. So let's close the standard trailing stop for cTrader. We're going to do a video about advanced protection in the future for sure. And let's go back to the average true range. To use it, we will download the indicator Chandelier Exit from CDDN. Chandelier Exit was developed by Charles Lebeau, and it uses a formula of the average true range to provide a trailing stop for your positions. It's very easy to download custom indicators from CDDN. All you have to do is go to your function indicators button and search for the indicator you want to download. You see here, if the indicator is not found in your local indicators, it's going to show you results from cTrader Developers Network. So you're going to see Chandelier Exit here. We can click it. We can go to the CDDN page is going to open. We just click the download button. Then we run the indicator that we've downloaded. Press yes, and the indicator has been installed. You don't need to restart the application or anything. So go to your, after you install it, go to your custom and load the indicator and set the periods and the multiplier. The default periods is 22 periods for the Chandelier Exit and the default multiplier is 3. However, you can use, you can play with the settings and use something that suits your trading system better. I prefer 4 multiplier, for example. And now let's plot the indicator. Now you see that there are some red dots and blue dots that are plotted. These red and blue dots are the points that you will place your stop loss. As all trailing stops, the Chandelier Exit trailing stop works better in a trend. So if you enter your position here, for example, you see how the trailing stop is going to work. So let's create a limit order so I can show you an example. So let's assume that you have created this position and we have created on this trend bar. So we're going to place, the stop loss is going to be placed exactly on the Chandelier Exit. The blue line is for long positions, the blue dots, and the red dots are for short positions. So the trailing stop is going to be, you're going to be moving your trailing stop exactly on the Chandelier Exit dot as the price is moving. So you're going to see, you're going to be moving it here, 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 this dot, this dot, this dot. Any new candlestick that comes up, you're going to be moving it. And at this point exactly, the trailing stop is going to be hit because the trailing stop only moves with the direction of the trend. not at the other side. So here it's going to be hit by this candlestick, so you got all this, and that's pretty cool. If you open a new position again, here you're going to be trailing with the Chandelier trailing stop like that. In today's video, we talked about the average true range indicator and its properties. I showed you how the average true range is calculated, how it looks, and how to use it in your trading. I also showed the Chandelier Exit and how to use it for trailing stops. In the next videos, we're going to talk about some famous oscillators like stochastic. And if you like this video, don't forget to subscribe, and if you want, share it with your friends. Thanks for watching.